Yesterday, it was the Bank of England monetary policy announcement, and the market believes that Andrew Bailey, the governor of the Bank of England, did them dirty. After his comments a month ago saying that they will have to act, it seemed a rate rise was on the cards. But with the old lady choosing to hold rates for now, Bailey has now earned himself Mark Carney's old nickname as the Unreliable Boyfriend. So why did the Bank of England choose to not raise rates? Let's discuss in today's Market Movers Daily. Hey, I'm Nicholas, welcome to the video. So Larry Elliott from The Guardian questioned Andrew Bailey on his decision. He said, "The markets were clearly expecting you to raise rates at this meeting and you didn't. Is it a failure of communications on your part? And is there a risk that you become unreliable boyfriend number 2? So, Bailey said that he's not an unreliable boyfriend and that the decision was a close call, which they spent many more hours than usual discussing this time around. And you know what, if he didn't like the unreliable boyfriend tag, I'd suggest he steers well clear of Twitter because there was much worse going on there. This one from Richard Murphy is actually on the polite side compared to others I've seen. He says, "If only Bailey knew it's better to keep silent and have everyone think you're a fool than to speak and to have everyone know that you're one." But was Bailey a fool, or does he have good reasons for not raising rates? Well, the important point is that he said they will need to raise rates, but just not yet. This part seems reasonable because he pointed out that the labour market is going to be an important factor in deciding how far they should go with the rate rises. Right now, they don't know whether the end of the furlough scheme led to job losses, although real-time data shows a tight labour market and that unemployment isn't expected to rise much. But by waiting until at least the December meeting, they'll have a better understanding of that whole situation. And it seems that most MPC members are more worried about an early rate rise harming the economic recovery than a late rate rise allowing inflation to get out of control. As they said, it would be difficult to cut borrowing costs if the economy stalled, but interest rates could be increased as much as needed if inflation rises more. So to me, that all sounds fair enough, but I know that people's issue is not with all of that, it's with the fact that Bailey made the comments in the first place and caused the market to expect rate rises were coming, which of course they are, but not right now. So was that part necessary of him going out and making those comments? I don't know. Let me know your thoughts in the comment section about all of that. Another concern about raising rates already was that inflation may actually fall faster than their forecast due to the way that they actually produce their forecast. So Bailey said, in the current forecast, in line with the current convention, it assumes that wholesale energy prices follow their respective futures curves for the first 6 months of the projection and are then flat beyond that point. So basically, their forecasts aren't factoring in the drop in energy prices that's coming in the future, or at least that the market expects is coming in the future. And on top of that, GDP growth was lower in Q3 and Q4 than they'd forecasted it to be when they forecast back in August. This is partly due to the supply bottlenecks, but also due to inflation, which reduced the disposable income for households and therefore has caused consumer confidence to decline. So again, since economic growth isn't as strong as they wanted, going too early with rates increasing may make that situation even worse. So it's better for them to hold off for now. So overall, expectations now are that a rate rise will come either in December or some people think it will come in February. I think the jobs number is going to be very important. Not Nostradamus, I think it's quite clear the jobs number is going to be important to understand the timing of that, the first rise in the interest rates. So we've got to make sure we keep an eye on those numbers so we know what's coming up. And you know what? Let me know your prediction in the comment section. Do you think that the rise will be coming in December or February or maybe even longer? And what are your thoughts on this whole situation? Did you manage to profit from any of the big moves? For me and what I'm looking at now, GBPUSD is looking quite interesting. I know there's a lot of momentum there, but it's quickly approaching a major swing low. I call that point a fundamental reference point as well. And using the Duomo method, we can see that it's also a strong path of resistance, a lot of confluence around there from various different levels, including the confirmed extension levels that align with that swing low. So if momentum can show signs of dying out and we get an appropriate close with a type 1 or type 2, I may be tempted into a long position. If momentum stays high, which it's looking like it is right now, and we've got NFP coming up later, then I'll just leave that whole situation alone for now. And I think if momentum with GBP continues, I'll just leave GBP alone completely, all currency pairs involving that. So that's our first full week of Market Movers Daily. Let me know in the comments if you like this new format. Don't forget to hit the like button to support the channel and subscribe if you haven't already. Have a fantastic weekend. I'll be back next week. See you then.